let's talk about three kind of basic types of loans here. The first one is going to be an amortized loan. The second one is going to be an adjustable rate mortgage. And the last one that we discuss is going to be a straight loan. And I'm going to go through some common loan types that you will definitely get experience with when working with these types of loans. An amortized loan means that the payment, the principal and interest payment, is the exact same. The payment is the exact same for all the payments. So if you've got a 30-year mortgage that is 360 payments, it sounds terrible to say it like that. So I try not to say it very often because it seems overwhelming. But all 360 payments, if you do all of them, the principal and interest payment is going to be the exact same every month. Okay, it's locked, it doesn't move. Your taxes and insurance might adjust, but the principal, the P and the I, the principal and interest remain the same through the entire term of the loan. So this little graphic I have, your first payment, you maybe have a total payment here. 150 goes towards interest, 150 goes towards principal, and now here's your new balance. And then we make an adjustment, right? But that payment equals the same for every single month or every installment, okay? Some basic types of amortized loans that I absolutely think you'll work with is a conventional loan. Conventional loan is probably the most standard type of loan out there. They usually have higher standards for qualification, for debt to income ratio, and credit score. One thing that they do have, though, is private mortgage insurance. Private mortgage insurance is a fee paid by the borrower anytime they put less than 20% down. Now, a great question for the exam is, what does private mortgage insurance cover? It does not cover you in case you lose your job. It helps you make mortgage payments. No, they're insuring that 20% that you're not putting down. So if you only put 5%, they're maybe insuring that 15% because you're a higher risk borrower in the eyes of the lender. So they're going to have you pay private mortgage insurance in case you default. They've got insurance on that top 20%. Okay. Another very common type is an FHA insured loan. Now, while any bank can do these, the mortgage insurance isn't provided by a private business like the PMI is. The FHA insured loans usually have a little bit more leniency on debt to income ratio and credit score. An FHA loan only requires 3.5% down. It's a great loan product, but because some of those borrowers can seem to be a little bit more risky, sometimes it's for a lot. Sometimes people have low credit because they've got lack of experience with credit. This might be a good product for them, but instead of going to a private provider for this mortgage insurance, the government provides it. So it's a government insured loan. The Federal Housing Administration that is managed under HUD, Housing and Urban Development, they actually provide the insurance on this. Okay. And unlike private mortgage insurance, by the time you pay the mortgage down and the value appreciates and goes up, you can call the lender and see if that private mortgage insurance can be removed, which would sometimes save a homeowner on their mortgage payment maybe $60 to $100 a month, depending on their situation. FHA loans, this insurance provided by the government never goes away for the term of the loan, but it is a very good loan product. FHA is one of those products that was created with the New Deal by President Roosevelt right after the Great Depression. And this was a product that absolutely saved our lives because banks did not want to loan money. It was too risky and they didn't have any to loan, by the way. By creating a product that the government provided the insurance in case of default, that now allowed banks to go and start lending money again. And real estate is a big deal, new deal, big deal, because it puts a bricklayer, a foundation person back to work, a framer, a roofer, a landscaper, a painter, an electrician, a plumber, all those folks that are in help build a house. It puts them back to work. It gives the lender a reason to show up. It gives the real estate agent a reason to show up. And then what do people normally do when they buy houses? They go out and they purchase consumer products like vacuum cleaners and pets and all of those things that make the economy go round and round and round. So this loan invention was a big deal, but they're for that low to moderate income borrower. There's definitely a cap to the amount that you borrow. I think the cap is probably in the 400,000s though. So it's a pretty large amount. A lot of folks think that this is first time home buyer. And it's not. Anyone can use an FHA loan, but you can only have one FHA loan at a time. So this is not a product that you would use to buy investment properties. A VA guaranteed loan. This is for our veterans. If you're a veteran, this is for you. This is one of the very last 100% financing products that has remained in existence through time. And this is for our veterans who have served active duty. They can qualify for a VA loan, and it's 100% financing. And again, the mortgage insurance, because they're not putting any money down, is actually provided by the government through the Department of Veteran Affairs. What I do want you to know is the term certificate of reasonable value. This is a VA loan's form of an appraisal. I think that's really good for you to know for the exam as well. And one other loan that might come up is a USDA loan. This is a government loan through the Department of Agriculture for communities less than $10,000, less than 10,000 in population. So if you're going to be working in smaller communities, this would be a really good program for you to know about that is also 100% financing. Okay, now here's a sample overview that I found a lender that provided at Gershman Mortgage that I thought was very helpful. Just about, you maybe don't need to know a lot of these things like for the exam, but it does show a minimum down payment, maximum loan amount, what seller concessions would be allowed. So this might be a quick screenshot for you to maybe have for your career. I thought it had some good content. Again, not necessarily for the exam, but for your career. Next up, we have an adjustable rate mortgage. And what this means is adjustable rate mortgages are also known as an ARM loan. And I think a lot of people confuse an ARM loan with the thing that like reaches out and hands you the money to borrow to buy a house. It is an acronym that stands for adjustable rate, which means the rate can move, it can adjust. Now, most ARM loans, for example, are going to be like a 5-1 mortgage. 5-1 ARM means the rate is fixed for 5 years, and on the 6th year, the interest rate can adjust up or down up to a full point. And if the rate adjusts and your payment goes up, that can put a lot of homeowners in a pickle because statistically, most folks live paycheck to paycheck with less than $5,000 in accessible savings. And these adjustable rate mortgages were used a lot prior to the mortgage crisis in 2008. Back before then, when we were doing 100% financing, folks were getting an 80% conventional loan and a 20% adjustable rate. That's how they did the 100% financing. So when this rate adjusted and their payment went up, you put that in combination with maybe a deductible for health insurance, tires blow out and you got a major expense with that. And all of a sudden these small things snowball and they multiply, and you get behind on one payment, and then the fees on it from the bank triple, and it's hard to get caught back up. And this is what started the crisis. Okay. A lot of it had to do with these adjustable rate mortgages. Another term I'm going to put with this is negative amortization, or on the exam I've seen, reverse amortization. The rate can only adjust up to 1 point in a 5-1 ARM. But what if the rate of return the bank needs is 2 points? They can change your payment up by 1%, but how are they going to make up for that other point that they're missing? Well, they can't change your payment, but they can add it to the balance of your loan. So instead of your loan going down, you're going to be paying it down, but they're going to be adding these extra fees. That's the idea around negative or reverse amortization. Last up is a straight loan. This is known as an interest-only loan, where every month you're only making a payment to the bank for interest. You're not paying down the principal balance of the mortgage. This common type of loan that you'll use with this is a construction loan, where someone goes out and maybe custom builds a home. They go out and buy the lot, and this construction loan funds the lot. Then the builder comes in and starts building, and as they need to pay off the roofer and the plumber and the electrician, they'll do a draw against this construction loan. So instead of making a full payment, the borrower during the building process is only making a payment on the interest. Then when the property is completed, they will reappraise it and package it into a traditional conventional loan typically. So a straight loan means we're paying the interest only. Okay. Up next, we're going to talk about some other financing techniques that folks might use when they're purchasing real estate.